Whenever you're ready.
Alright. Hi everybody, how are you doing today? My name is Mason, my friend Joseph here, and Luke. We're at Montana State University at Bozeman, Montana, and we're just here to present to you guys our analysis of Radius Recycling.
So our investment summary on Radius Recycling, we issued a hold rating on the stock. As of January 18th, we had a price target of $28.37, and then the current price as of February 28th was at $20.59. We still think the stock is fairly valued at that $28 mark. Key drivers we took in analyzing the stock: operating expenses, commodity prices, interest coverage, and then strategic partnerships. Here's a graph showing the correlation between the S&P 500 and Radius Recycling stock. As you can see, Radius typically tends to move with the S&P, but it is a little bit more volatile than the benchmark.
So Radius overall is a steel manufacturer and metals recycler, and they focus on both ferrous and non-ferrous metals. They have a new strategic partnership with the Home Depot, which in the last year has generated 140,000 tons of recyclable materials for them. They are unusable Home Depot, and they go to Radius Recycling. Their unique strategy is using the circular economy, which revolves around sharing, leasing, reusing, repairing, refurbishing, and recycling existing materials. Given that waste is such a pretty big problem globally, they're really on the forefront of solving this issue in the US at least. They're also involved in the commodity business, which brings some volatility to the equation, which we will delve into later in this presentation. Location-wise, they operate in three main regions of the United States: the West Coast, the South, and the Northeast. Their locations are split pretty evenly between two types of locations. One, their traditional metals recycling locations, as well as their auto locations that are called pick and pull. They also have one steel manufacturing plant in Oregon. Their ESG is very highly rated by S&P. They were given a score of 55, which is high in the grand scheme of things. And this is because environmentally, they're a recycling business. They have net carbon-free electricity. Socially, 90% of their facilities are free of injuries, and they do 1,600 hours of volunteer work, and they have good governance, most recently with higher female representation on the board. Industry-wise, they're a unique company because they operate within three different industries. Obviously, primarily, they are a metal recycling business, but they also participate in auto dismantling and steel manufacturing. Looking on the right side of the slide, we talk a little bit more about the metal recycling market ranking, with Asia Pacific being first, North America, where they operate, is third, but the market size is projected to be $143 billion by 2036 worldwide. Their competitors we identified were Materion, Metallis, and Universal Stainless and Alloy Products. While not all of these companies participate in metals recycling, they are all part of the metals industry, which, as I previously stated, they are part of that kind of scheme. And it is a very competitive landscape with a lot of barriers to entry. Radius currently does have a negative profit margin, which does not put them in a good market position.
So for financial analysis, a few of the main things we focused on were the revenue, cost of operations, and interest coverage. So for revenue, 50% of Radius's revenue comes from ferrous metals, while 27% comes from non-ferrous metals. And as you can see in the graph, 81 to 88% of total revenues is eaten away at cost of goods sold, which is one of the factors we consider for the R hold rating. And then interest coverage. On an EBIT basis, they have a large fluctuation in their interest cover ratio. Between 2021 and 2023, there's almost a 44-point variance. We just thought this was interesting because in the high interest rate environment the current global economy is in, it could be a situation where Radius would not cover interest payments. And they also have a very large cost of debt. They have an amended credit agreement through BofA that's based off the secured overnight financing rate and the Canadian dollar offered rate. And those two rates are sitting about 5.31%. And on top of that, BofA has a spread of 1.25 to 2%. So Radius is borrowing around 7% on their debt. Additionally, price of sales, Radius has a price of sales ratio of 0.32. That just indicates they have a strong revenue, but not high gross income because of their cost of goods sold and operating expenses eat away at their revenue. On a positive note, they do have a dividend. They've issued a dividend every year since they've been public, and that helps bring stability to that stock price. The last two ratios we focused on was the return on assets and return on equity. Both those ratios are negative, just showing that they have negative net income and the company's assets they've chosen to invest in are not yielding income.
Alrighty, next up, we're going to kind of focus on the effect of commodity pricing on the company. So as a whole, as Joseph mentioned, both ferrous and non-ferrous metals play a big role in our revenues. So here we've got a producer price index for ferrous metals. It's done on a basis and going out to November 2019. And the blue line here is the price index, and the orange is the operating margin for radius recycling. So as you can see, typically over time, when the increase in ferrous price index increases, typically the operating margin for radius follows suit. Obviously, there are a couple of outliers like most things, but that's the mention. Continuing on, one of the largest things we focus on, as Steve mentioned, was the commodity pricing. And we focused on this by analyzing it using regressions. We did a regression on ferrous metals on a 10-year time frame on a quarter-over-quarter basis. And we found that 60% of the variation of revenues was due to ferrous metals. So that's pretty big to think about that. And on top of that, we also did with non-ferrous metals, same time frame as well as basis. We found slightly larger variance in revenues due to non-ferrous metals. So if you think about this, all of the variation in revenues is due to things like commodity pricing. And continuing on to that, so we mainly evaluated this company using a DCF valuation model with the price of 28.34 is what we found. We did this first by calculating the WACC, and between the WACC, long-term growth rate, and looking at previous fiscal years, we came to an indicated value of $28.34. And just a couple of projections we have based off previous years and our future outlook for fiscal year 24 and beyond. We see an increase in revenues due to the increasing demand for ferrous metals. We said roughly a 15% increase, hopefully, for fiscal year 24. We also looked at the cost of goods sold, which previously mentioned is a big problem for them because it's incredibly high. But in many ways, it's within a percentile ratio, is pretty close to each other and stable. And also, operating expense as a percent of revenue is relatively consistent, which is also something we looked at when evaluating the company using the DCF model. Next up, we've got a PE evaluation. Now, we didn't really take this PE evaluation into consideration with our price. We more just took it and run with it to kind of value the company and kind of see where they are from a different standpoint, a different lens. And we did this, this helps reiterate our whole rating because it's not a great outlook when regarding their earnings and their PE ratio. Because as you can see in the year 2020, and a negative PE ratio of roughly 200, which is definitely concerning, and a negative earnings. But as you can see from fiscal year 2020 to 2021, they're actually able to flip that to around pretty good for the year. So that's definitely something good to see that they're able to turn that around quickly.
And then the risk factors with the investment side in mind, we identified the main risk factors as high cost of goods sold, the high cost of debt, looking at the quick ratio, and the reliance on external factors. The high cost of goods sold and the high cost of debt, mainly because of the commodity pricing, it's hard to look out in the future and predict what revenues could be because your commodity prices can be really strong, but they can be very weak, which have a negative or positive impact on the business. And then revenue growth and consistency, because of those commodity prices, it is hard to predict what revenue growth could be. So overall, we gave Radius a hold rating because on the positive side, it has strategic partnerships with Home Depot and is very well integrated into the industry. The uncertainty of commodity prices, this is the biggest one because this is what eats away a large of their income. And the popularity of ESG funds, Radius has over 80% of their stock held by institutions, and a lot of institutions in recent times have been adding ESG stocks to their portfolio because they're trying to make the environment a better place and reflecting the good governance of the business. And lastly, the DCF and PE evaluation came to the conclusion that Radius is very valued at the $28 mark.
And that'll do it for us. Thank you.
Great job, guys. We'll open it up to questions from the panel.
I could ask one. Thank you guys. Did you guys take a look at the management team and what kind of stability they've had in their executive office?
Yeah, so we listened to the call that we got. think. And with it, a manager spoke. And then I looked in terms of their representation. And the only thing was they weren't as recognizing of the fluctuation in all of the volatility of their stock and that kind of thing. But
So,
yeah.
So I guess in the scheme of things, we don't really, we'll probably have to dive more into that in the future, regarding their management kind of changes.
There was a lot of focus on the environmental aspects, a lot of talk of ESG from the information that we had, and less kind of financial stuff.
Thanks.
So maybe a question on the competitors that seem to have much better profitability. Can you maybe, are you aware of 1 or 2 points what they're doing differently compared to Radius?
Yeah, so they are kind of in different markets. They, like, Matreon is a producer of, they work with, beryllium and other metal products. And because of that, it just shows the diversity of Radius's competitors. And that is kind of what I think changes the game for them, is just the different product offerings, because Radius is still competing in that field, even though primarily they are a recycling plant.
And then to just add on that, Radius relies heavily on junk cars for their ferrous and non-ferrous metals. And in recent times, as we've all witnessed, interest rates have skyrocketed. And a lot of people are not getting rid of those old junk cars anymore. They're holding on to them because the high cost of borrowing for the new car. And that kind of hurts Radius's business because they don't have access to as many junk cars as they could. And while the other competitors are doing finished steel, or as Luke said,
the finished steel products, or working with other types of non-ferrous metals. It just creates that variety and diversity of competition, making it complicated for them to compete and making it competitive.
Okay, thank you.
This is Billy. So, is there an ideal economic backdrop for these guys where demand would be extremely robust and the ability for them and pricing is good on where they sell, but on the supply side in terms of their recycling costs are low? Have they experienced that type of environment at some point in the last 10 years?
yeah, so historically, with interest rates being low, Radius has had cheap debt to borrow, which has allowed them to expand the business into the non-ferrous and ferrous metal markets. And then on top of that, they had an abundance of junk cars, and people were buying new cars and getting those cars at a quicker rate. And commodity prices are relatively stable. So with commodity prices being relatively stable, they had access to the junk cars, they could turn around and make a profit off of those. But since COVID and then the Russian invasion of Ukraine, commodity price index have been a bit more volatile, which has hurt Radius in the sense of profitability.
Okay, and this is Billy again. I've got one follow-up. So I read their 10Q and K recently. So I'm a little confused over their relationship with Home Depot. How is that structured?
Yeah, so with Home Depot, there are products that they can't sell or recycle themselves locally, so Radius has partnered with them to take those supplies and, take those metals and process them at their facilities. And it's kind of increased their brand image, honestly, because now that there's this known relationship between Home Depot and Radius Recycling, it's just been kind of publicized, and it generates, in total they're doing 4.7 million tons of metal processing and recycling every year, and it's generating 140,000 a year, and just because it's recently started, hopefully that would open them up to other partnerships of that nature, and further increase that kind of line of credit, if you will.
This is Bo. On the company overview, I noticed you guys called segment to their business. Is that a distraction, a growth, an area that they're trying to grow into, or what's the role that you guys see that type of processing for them going forward?
That's a good question. So I believe roughly 17% of the revenues actually come from that steel manufacturing plant. So that's definitely an area they could definitely improve on, because if you guys go back to the map real quick, for the amount of things like their recycling facilities and their pick and pulls, and just the one steel mill, for 17% of the revenues to come from the steel mill compared to the other like 100 locations they have in different aspects, it's definitely an opportunity that they have themselves. Because for how small a position it is, it definitely generates some good revenue for them.
Our understanding from the management's perspective is that they weren't interested at the time in expanding into creating, rebar and wire coils and those kind of steel products. Further, because it's there's a high barrier of entry to even further themselves in that industry. But us as a team, we're recognizing that might be a little, that could generate some consistency in the revenues, which they might need.
Thank you.
You're welcome.
This is Chris. One question on capital allocation. You said that the dividend provides stability, perhaps, potentially. What would your view be if they decided to cut the dividend or discontinue it and instead pay down some debt and maybe lower their interest costs?
Yeah, for sure. So if they were to cut the dividend, a lot of people do hold stocks because of the dividend. They do, people like that, like security income. But I feel if Brady's were to cut that dividend, it would allow more people to invest in it, because it's a sign that we are cutting our dividend, we're investing in our business to further grow our operations and to make more competitive.
And just to kind of like piggyback off that, obviously, like you said, the dividend definitely helps people because it's a stable income and you're going to get it. But at the same time, if they were to get rid of it, it might be able to, Brady's able to take that money instead of putting it towards dividends to helping their company increase in other areas with those funds. So it's definitely got some pros and cons to it.
And then we wouldn't have to borrow more capital, because from our understanding, they're using the amended credit agreement with BFA, and part of the money they're using from that is to pay that dividend. So if they were to stop paying that dividend, as we just said, they would be able to pay down debt and grow their business.
Do we have time for one more?
We have, minute 30.
Okay, this is Billy. So my final question, you guys, is that in their 10Q states that they were sued by the Oregon EPA in terms of environmental violations back a number of years ago. How have they addressed that, and holding yourself out as an environmentally responsible company, are you comfortable with their response and how they've reconciled that situation?
So that's a great question. Unfortunately, that's something we probably have to research further to get back to you on that, because we aren't entirely familiar with that, so it'd be something for us to look into in the future.
Something we did see though was, what I saw was that they had fires in their facilities in California, and we couldn't find their exact response to that. But yeah, that's kind of what we saw with the fires. But yes, we'll look into that and get back to us.
Yeah, research is always a process.
Great. Well, that's time, guys. Great job. Congratulations. You're complete, and I'll be emailing you the results. And best of luck in the future.
Awesome.